Welcome back, everybody, to another episode of Alt Reports Radio. I'm your host, Brett Palumbo, and I'm happy to be on here with Sabrina Guler today of Techvestors. And we're going to talk about something that's been on my mind for a while, which is investing in short-term rentals and in real estate. So, Sabrina, thanks for jumping on here. Tell us a little bit about what brought you to where you are here at Techvestors today.
Yeah, absolutely. Thanks for having me. So Techvestor is a short-term rental fund. We buy single-family homes nationwide, and we convert them into beautifully designed Airbnbs. Funny story how we got into it. So it's my business partner and I, Seif. We both come from tech backgrounds. I worked for Apple for a couple years. I was in hardware engineering. I used to work on the AirPods product line. And Seif worked for Facebook. He was in recruiting. And we both were investing in real estate individually in our own kind of journeys. I've owned my own Airbnbs prior to Techvestor. And we ended up working in our own subgroups of Apple and Facebook. And we started helping people internally at work. High income, W-2 earners. That was kind of who we started working with. I ended up getting my real estate license at the same time while I was working at Apple. It was something that I had carried a lot of interest in as a passion. And then we decided to start Techvestor, not only to help other people diversify their investment strategy through short-term rentals, but yeah, that's how we got started.
Okay, that's cool. So how long has Techvestors been up and running?
It's been since July 2021, so a year and a couple months.
All right. And so talk to me a little bit about your investment thesis there. Why Techvestors? What are you aiming to do?
So for those of you who have invested in real estate as an individual, real estate can be a lot of work. Airbnb is a whole other commitment to real estate. You have to find a property, and that's because we invest nationwide. That's hard to narrow down markets. So funny story, because Seif and I have a background in tech, we built a proprietary software that runs every MLS listing that hits the MLS nationwide. It runs that through a pro forma that we use for our fund, and it narrows down a bunch of markets that deem viable for the target IRR and cash on cash that we look for our portfolio. And then because Airbnb is very aesthetically driven, we have obviously a lot of people, humans, that look at the homes, and we make sure that the homes we make sure that whatever market that we're investing in, whether it be, a mountain market, a beach market, a city market, that home can produce the revenue that we're going after based on the design that we have internally. So that's how we narrow down our homes, which is big because it's very time consuming to look for good deals, to scrub markets. So that's one side of our business that really helps us find property. And then we are vertically integrated. So we also have our operations team internally, which means we do our own construction, we remodel all of our homes, we furnish and we design everything internally. We have a team of 12 project managers, and they fly out, they handle all of our projects individually. For a while, it was me going out there and doing all this. I have many funny stories that I can share on that journey. But that's also a big advantage because, especially, who wants to go to the Poconos, Pennsylvania, and build furniture and do that whole process? It's exhausting. And then also, I think now a big topic has been interest rates and markets, and you've seen some markets do really well, and you've seen markets flop based on what's been going on. And the nice thing is that we are a portfolio. Right now we have around 70 properties, single family homes. They're anywhere between 3 to 6 bedrooms. And we're in 10 different markets. So you get a nice blend, which is always nice in terms of risk management and all that good stuff.
Yeah. So talk a little bit about those markets. Where are you optimistic right now? Where are you looking to invest?
So we have a blend. So we have some really lucrative mountain markets. So we're in the Poconos, Pennsylvania. We are in Blue Ridge, Georgia. Most of our markets are 90 minutes from major cities. Like, Blue
Okay.
Ridge is 90 minutes from Atlanta. The Poconos is 90 minutes from New York City, all by car. And we picked those because when we started the business, we started during COVID, and it was very natural for people to not want to get on planes. They wanted to visit these markets, and that continued. And that's why, I think Airbnb just released their Q3 revenue for this year. They're up 29% year over year from this time last year for that reason. I think a lot of people were wary of Airbnb, worried that, post-COVID, that travel would go away. But we've seen a huge upswing across all of our markets, actually. Not only our mountain markets, we're also in Scottsdale, which is a pretty busy metro. Phoenix has been doing very well the last 3 or 4 years. We're in Tampa. So we have this blend. We're in the true vacation rental markets, and then we're also in these tier 2 cities that you've seen some really great returns across all real estate, right? Not only short-term rentals.
Yeah. So at 70 assets already, you're talking about, are you buying, is it one a week, or what sort of a pace are you on with that?
So we based, it kind of happened by accident because it was based on how much capital was coming in.
Okay.
And obviously on the right deals, right? Like every property that we buy, we vet extensively before it comes into our portfolio. So if you average it out, sure, it was around a property and a half a week, but it kind of came in sprints based on capital coming in.
Okay. So I want to talk a little bit more about the actual properties. We talked a little about the locations. Tell me, what are you looking for in a property? What goes into your portfolio?
So we have a data team internally. We're really big on R&D. I think with Airbnb, there are a lot of things that make a property do well that are not obvious to the public. I think there's a statistic out there that the average person on Airbnb before they book, so if you're a guest shopping for a vacation home for the weekend, I think they only look at the first 3 or 4 photos and they spend 7 seconds looking at the homes. So we look at what amenities are people offering in that area, why are they doing really well, what revenue they're producing already, and obviously location, proximity to ski lodges and golf tournament spots or whatever is known for that area. Yeah. So we look at all of that, and then also we target the 3 to 5 bedroom home for many reasons. One, appreciation for single family. That's usually the target sized house that does well on resale. And 2, we believe as a company that hotels will always do well, but it's always economically friendlier to offer a family a 3 to 5 bedroom home. I mean, if you're 2 or 3 families traveling for the holidays or doing something, it's way better to be together in a home rather than 3 to 4 different hotel rooms, right? Yeah. So that's kind of how we narrow it down. We're very, very specific. We're very data driven with everything that we purchase. We've seen homes in certain areas that don't have hot tubs produce 15% less revenue than homes with hot tubs. So just small little metrics that are so key that allow us to really hit our revenue targets per year. So we look for majority amenities and then also location and all that good stuff.
Okay. So when you're evaluating, and I'm going to ask you a little bit about returns, and I know we're not going to go too deep into some areas of this, and folks can get in touch with you directly if they want to really dig into numbers after this is for accredited investors only. Is that right? I just want to get that out before we go too far. Yeah. Okay. So talk a little bit, if you can, about what you target for a return. If you're evaluating a property somewhere, what does that property have to look like? It might return to you in a year, or on whatever your metric is in IRR for you to pursue it.
So that's a great question. It depends on the market. And again, that's a benefit of investing with a portfolio. So I'll give you an example. Scottsdale, some of the homes can produce anywhere between a 5 to a 10% cash on cash in terms of revenue year round. But that is a very stable market. And traditionally, if you were to buy multifamily, you're looking at like a 3 or 4 cap, when you enter that market. So that's a very stable market as is. When you look at the Poconos, we've underwritten homes, we've purchased homes that'll produce a 25% return.
Cash on cash. Like excluding appreciation or anything else, just a cash return, annual cash.
Sure.
Return.
And we've had some that have been even higher. So it depends on the market. Right now, our target average annual cash flow over 5 years is a 9 to 12%. And our trending full operational year cash on cash is supposed to be anywhere between an 8.5 to a 12.5. Right now, we're actually right on target. We're a little under a 9. So yeah.
Wow. So what is the strategy with regard to hold period? Do you have exits planned for these when you buy them, or is it just buy and hold and forever, or what's the strategy there?
Right now it's a 5-year target hold and then sell as an exit. Obviously, we're paying attention to the market and we're going to do what's best for everyone involved. But right now we're targeting 5 years. Okay.
Is your fund leveraged?
Yes.
Okay. And is it a blanket or a wraparound? Or do you get individual debt for each of these assets, or how does that, I guess what I'm trying to get to is what is the exposure when somebody invests with you? Are we investing in individual assets, or are we investing in the fund as a whole? Does that fund have leverage on it in its entirety, or individually? Is it like siloed by property?
So you're investing in the LLC that holds all of the properties, and we are leveraged per single family, so per asset, but it's under that one LLC.
Okay, cool. So there's not a lot of good news in the market today. I think people are looking for some. I've felt like short-term rentals. In fact, I wrote a post about this not very long ago. I feel like short-term rentals, personally, are a better bet than a lot of what's out there, mostly for a lot of things we've talked about, like the fact that the returns, the cash-on-cash return is so much better than a traditional rental right now. But what do you see happening in the market, and how is that impacting any of the decisions that you're making? We've got our soaring interest rates and potentially, lower home prices. So how is that factored into how you're operating now?
Yeah, sure. So obviously our area has been impacted purely from an interest rate perspective. And also you see some prices coming down in some of our markets. We like to tell people that we're a cash flow fund first. So we're still buying deals that are obviously cash flow positive. We're still finding some really great deals. We are buying at higher interest rates. If we can, and when the time is right, we plan on refining. Obviously, hopefully at a lower interest rate. And but we're cash flow focused first. So we're still finding deals, and we're still going on strong. Okay.
So one of the things I have on here to ask you about is your edge, and it sounds like you've touched on that a little bit with it. You've built some in-house technology. You've got developers on staff. Is that sort of your model? Is it's an in-house dev team that's building this kind of thing out for you, or what do you feel like your edge is?
So I think software is definitely our edge because it allows us to find the right deals with speed. Yeah. And it allows us to also buy in different markets. You're benefiting from a portfolio. But I also think our edge is our operations team. It is very difficult to do this at scale. And I'm sure those of you who are in real estate, you don't often find like a nationwide flipper or someone who could like help you remodel nationwide. We've built that infrastructure in different markets. And we also, I mean, storing furniture, having designers in different markets, it's, you know, you're in hospitality almost, right?
Yeah.
And that's a hard thing to come across. So we also have that in-house, which we're very grateful for. And it also helps us not only find properties at speed, but also deploy capital and get the properties, you know, revenue and cash flow positive sooner than later.
Yeah.
So our execution is also very fast.
So what do you feel like the risks are right now in the model that you have? Like, is there something that's keeping you up at night, or that you're thinking about risks that you're mitigating or you're actively mitigating right now? Or what is it that, you know, nothing, there's no investment with return without any risk, right? So what do you feel like those are for your fund?
Yeah, sure. So I think a few things that come to mind. So obviously everyone's looking at the market right now. We ultimately don't know what's going to come 2023, 2024. I
Yeah.
think that's more so from the buying perspective, that we're trying to understand what prices mean, where are they landing, interest rates. I think, and that's where you're seeing a lot of this like silence in the market right now, because a lot of people are kind of at a halt. The good news is that, again, we're a cash flow fund, so we're focusing on that primarily. And then also, I think one thing that would be a risk if we weren't where we are today is our vertical depth in each market. Most of the markets that we're in right now, we have several assets already doing very well. They're live, they're listed on Airbnb. So we've already like set precedence in the market. And actually, if you look at our listings on Airbnb, and you go, you know, you do a search in like Clearwater or in Scottsdale or in Poconos, most of our homes, we own, you know, anywhere between 5 to 10 homes in each of those markets. You'll see all of our homes pop up as the top ranked. So in terms of people hearing about that markets are oversaturated, Airbnb's a bust, it really depends on who's driving the listings and who's ranking them and how you're priced and how much ownership you have of those markets. So because we own so much and we're vertically in depth in those markets, we also set the prices because we're the majority. So I would say if we weren't in that place, that would be something that that would be a risk or something I would be keeping an eye on. And we always are keeping an eye on those things because there's people coming in, new owners. You know, STR is an ever evolving world. There's a lot of people getting into it at the same time.
Yeah.
But that's also a positive that that I see with being a part of our portfolio, because we have a lot of vertical depth in those markets.
Yeah. Yeah, I think for newer individual operators, if they got in, like, I know a lot of folks got in with, they took seconds on their personal residence, or they've got loans against their stock portfolio. Like, there's reasons that they might have to sell. You know, I think that having that mitigated by being in a fund, being across a lot of different properties like you are, makes a lot of sense. What do you think about, you know, when the 2008 crash happened, there was, and I'm not suggesting that we're going to have that, but it does seem like their consensus is in that 2023 is going to be a difficult year in, you know, a lot of regards. But what do you think about occupancy, and how do you see that playing out over the next year or two if we do in fact see you know, pullback here or a recession?
So two things. So I actually just read an article recently. I can't quote it because I don't remember where it came from, but it was just signs of the recession and where because, you know, you hear about layoffs right now. You're hearing about people cost cutting and doing other things.
Yeah.
And I think it was like some hospitality report came out referencing there has been no cutback on travel so far for next year's travel. So plane tickets, hotel reservations, Airbnbs, tourism. So that was interesting. I also think with the Airbnb world, occupancy is not looked at like regular real estate. So when you buy multifamily, you're looking at, you're hoping for 98 and above, occupancy for your rents. And with Airbnb, it's different. There are some markets that we underwrite where it's 50% occupancy, and they'll do very, very well. Like for instance, we're not in Big Bear, but Big Bear, there are a lot of people who own in Big Bear, California, and that market on average is known to have a 60% occupancy year round, and it still delivers a decent cash on cash if you're an individual buying, right? The average of our portfolio, we're in the high 70s in terms of our occupancy. Okay. And I think we're at 79%. So we're pretty high up there, but it's different for Airbnb because you're looking at the total revenue, and and there's some markets where some weekends book majority rather than weekdays. For example, like Scottsdale is a very heavy weekend market, whereas some mountain markets, people are like, you know what, I'm going to work remotely in the mountains. I'm going to spend a week there with my wife, and you'll have longer stays. So it really, the Airbnb world is very different when you look at occupancy and how it's impacted. You can still do really well with lower occupancy year round.
Have you got anything in Bend, Oregon?
No, we've looked at Oregon a while ago. And I've heard great things, but it didn't pencil for us. Yeah,
it's been pretty pricey here. That's where I am. We have quite a few. There's a big short-term rental market here. Although, I guess this is the next thing I wanted to ask you about is that in certain markets, I know certainly in Summit County, Aspen, Vail, and others, mountain towns, where there's some struggles starting to emerge, where there's pushback by local community about affordable housing and this sort of thing, which I think is, and in fact here in Bend, we're seeing that it's which for a long time we're out in rural, we're out in the woods in Oregon here, and it was sort of very affordable. And then now over the last years, as it's been discovered and people work remotely, prices are through the roof. Do you see any sort of regulatory risk or local, municipal, laws kind of risk in your market, or how are you mitigating that?
I think that's going back to what you mentioned about risks. That will always be one of them. It's like an ever-going thing. We just can't predict law. Yeah. I will say though, every market that we are currently in has very established regulation. So we typically don't invest in markets that are very in the process of figuring that out, because depending on the state, the government, the politics, you're going to have some side be in favor of. And we have actually been in markets in the past where, we were thinking about it, and that month they passed a law that, 30 days or longer, or a minimum of 6 people only in the house. So we do, a part of the operations team actually is to constantly be on top of permitting and to make sure that we're on par, up to code. And also in most of our markets that we invest in, there's a physical inspector that comes out to take a look at safety and all those things. So you do have a lot of markets that don't have that whole story figured out yet, which is a risk, but you also have plenty that do.
So you've talked about cash flow a few times. Are you able to talk about what the target is, or what you've been able to distribute so far, percentage-wise?
So I think I mentioned it before. Our target annual cash flow over 5 years is a 9 to 12%.
Oh, okay.
Yeah, and then
that's cash flow. That excludes exits and appreciation from. Yes.
Yeah. Correct. That's if you're talking about IRR, we're looking at a 17 to 24%.
Okay. Yes, I am talking about IRR.
Okay. Well, yeah. Total IRR is 17 to 24. That's what we're targeting, and then cash flow is a 9 to 12. 9 to
12%. Okay. Awesome. What is the minimum to invest with you if you're an accredited investor?
25,000.
$25,000. And the hold period, how long is the lockup?
5 years.
And what are the fees? Are you able to talk about?
Currently, we don't have fees. It's just your investment.
Oh, all right. So how are you getting? How is Techvestors earning money if there's no fees?
Operationally, that's how we just working on our houses, our project management, through getting everything set up. That's how we make money, and then obviously through our our return structure.
Nice. So talk to me a little bit about who makes a good investor for Techvestors. Like if somebody's considering this, how would they know if they're somebody who might, reach out to discuss further?
Anyone who's looking to diversify. And I think majority of our investors are like high W-2 income earners, people who don't have the time to buy their own real estate and set up short-term rentals that want the lucrative cash flow year round. So that would be our target investor. All
right. Well, awesome. Sabrina, thanks for coming on here and talking about this. I'm definitely interested in this market, and I've been hesitant because of all the reasons that you mentioned to get into an individual property, myself, just because of the workload and paying attention to it. Also, there's the risk of being just in the one single market. So I do like the Techvestors model where you spread as an investor, you spread that risk out, nationally. That makes a lot of sense to me. How should folks find you if they want to talk more about it?
Yeah, you can find us on our website to learn more and book a call directly there at techvestor.com.
Okay, great. Sabrina, thanks so much for coming on. Really appreciate it. I know most of the folks who are listening to this are involved in real estate and investment in some one way or another. And so I think this is going to be a great call for them. I appreciate you getting on here.
Thank you so much for having me.
My pleasure.